Good evening, everybody. Apologies that we are starting late tonight. Um, Sorry. There's a little change in plan, so that's the reason why I'm not supposed to take you tonight. However, the the lecturer for tonight is still at office now, so he just called me. So I just quickly need to um meet up. So apologies once again, everybody. So I quickly set up the streaming platform too, so that the people on the streaming platform is going to join us. So we are going to start tonight's class now. So sorry once again. So if you can see my screen, please let me know. If you can see my screen now, please let me know. Okay, sorry. Okay, okay. So um, good evening, everybody, once again. Um, our topic for tonight is IS 37, provision, contingent asset, and liability. So, IS 37 deals with the prescription on how to recognize provision, contingent assets, and contingent liability in the financial statement. So, IS 37 deals with was introduced to curb unethical practice in accounting. So, the quick introduction to this topic is that there are so many ways to manipulate financial statements. There are so many ways to do window dressing, which is otherwise known as creative accounting in financial statements. So one of it, a popular method is what is a popular method is depreciation. So when you want to manipulate your financial statement, you can use depreciation, whereby we have so many depreciation methods, straight line basis, some of the year, and the likes. So one of another way in which a financial statement can be manipulated is provision. So now IAS 37 now address this, that there are some recognition criteria that must be met before you can recognize provision. So provision is just like we know in our skill level, you have been hearing provision for doubtful debt. In a situation whereby you have a bad debt, everybody, we all know that the fundamental accounting principle of accrual basis. When you want to prepare a financial statement, you must use accrual basis. So there is no way you are not going to have receivables. So out of your clients that are owing you, there is some possibility. There are some possibilities that some of them are not going to pay you. So there is provision for that through debt, which can be 5% if you remember them. So now provision is a standard on its own, and provision is a liability. Is a liability. So that takes us to our first item tonight. What is a liability? A liability, in line with the conceptual framework, is a present obligation. A liability is a present obligation of an entity to transfer an economic resource as a result of past events. So please, let's get this liability very well. What is a liability? A present obligation. If you can see my screen very well, let me quickly discuss about this liability, because I remember anytime I take provision, anytime I lecture provision, there are usually problems. Like some people don't actually get it. So I need to highlight, let me quickly highlight this. Provision is actually a very interesting standard that when question comes out, originally you should be able to answer it. Or else, um although there are some stupid questions that I can just go and adopt from ACCA, then where they are just going to, just like 2023 diet. Is it 2023 diet? Yes, we solved that particular question during our APEX revision class. So that question is a combination of provision and one question, but actually provision is actually straightforward, very, very straightforward. So now liability. So first and foremost, let's pick it one after the other. What is a liability? A liability is a present obligation to transfer an economic resource, as a result of past events. So this definition, for you to say you have a liability, I need to, like, I am owing somebody. A liability is a present obligation. That means an obligation you are owing presently. Please, let's get that very straight. And liability is a present obligation in line with the conceptual framework. When in our chapter 4 of the conceptual framework, where we the ISB define the 5 elements of financial statement, which are assets, liability, income, expenses, and equity. So liability is a present obligation. It is something you are owing presently. So an obligation that will be in the future is not a liability. That means you and somebody, you enter into a contract today. Now that person is now saying, okay, oh, maybe next week or next month you are going to be owing me. That's not a liability. A liability is an obligation that is present, and that obligation is to do what? Is to transfer economic resource. This economic resource, that's the second point, is like a cash, an asset, or other things. That means liability is something you are owing, that it is very, very important and it's very, very sure that you transfer cash or assets or other thing as a result of past event. That means for you to say a liability is a liability, it must result as a result of past events, as a result of transaction that happened in the past and not future. So once you understand this liability, I think we can now move to provision. So now there are four types of there are four instances in this my scenario. Please let me I think for the YouTube people, let me unlock my screen. So the people on YouTube. Okay. So I think this is fine now. This is fine, right? Okay, yes. All right. So I quickly need to like unmute everybody because we know there are some people uh that will always distract us. So for us to be very fast tonight, we need to unmute everybody. So now there are four instances where liability can occur. Number one is there are some liability where the amount you are owing and when you are going to pay, that means timing, the time you are going to pay it and the amount you are paying is certain. That means you know it. That's point number one. When timing of liability is certain and the amount is certain, that is point number one. Examples of those liability are: number one, accruals. Accruals, when you are owing somebody, accruals. Then number two is trade payables. When you collect, when you received a goods from your supplier and you say you pay it in the future, that's accruals. Then trade payables the same. Then bank loan, bank overdraft. If you agree with me very well that when you go to the bank now, you and the bank, according to the contract, both of you guys will know that this is the amount I will repay, and this is the time I will repay. Do you agree with me? Can people react? Am I right? With that first instance, when you go to the bank, you collect loan or overdraft. When am I going to pay? How much am I going to pay? You will know it. That is number one. Then number two, when the timing of liability, when you are going to pay a liability and the amount is uncertain, you don't know how much you are going to pay and you don't know when you are going to pay it. It is a contingent liability. It is a contingent liability. Let me cite a very good example. A very good example is a situation whereby you enter into a contract with with a person. That contract now says that, okay, let me use this simple example. Example is a court case. Is a court case. The court case, you are in the court already. The case is in the court already. However, the as at the accounting period, you don't know what the case is going to give you. Maybe you are going to win the case and the amount in which you are going to pay. So that's one example of contingent liability, but let's put it one side. Now, we now have the third point and the fourth point, which is where a liability is uncertain. The timing of liability is uncertain, but the amount is certain. Then the fourth one is when timing is certain or amount is uncertain. That is provision. So provision, in line with IAS 36, the definition is a liability of uncertain timing or amount. A liability in which the time you are going to pay it or the amount, one of them is uncertain. One of them is uncertain. That is a provision. So it's just a simple definition. The standard gives a simple definition of provision. That means a liability of uncertain timing. Timing, when am I going to pay? I don't know, but I know the amount. Or I know when I'm going to pay, but I don't know the exact figure I'm going to pay. So that is just the definition of IAS 16, of IAS 37, which is provision. So now let's move on. Examples of provision. Number one is decommissioning cost or dismantling cost. A decommissioning cost is a cost that occur as a result of a contract. You enter a contract with an entity or with an individual that I'm going to use this asset, but in the future, I'm going to do what? I'm going to return that asset back to the normal state. Let me cite a very good example. This is a very, very simple example. Now, as an organization, I have a project. That project, I need to like carry out the project in the north. Currently, I'm in the south. My company is in the south. So I need to execute a project in the north, and that project is going to take me for 10 years. I'm going to spend 10 years in the north to execute the project. After 10 years, I'm going to come back to my to the south, to my head office. Now, do you agree with me that it makes sense that instead of me to buy a land to construct an office, everything there, do you agree with me that it makes sense that I should come back, I should lease that my office in the north? Since I'm coming back to the south after 10 years, it does not make sense that I should just go and buy a land or buy a property. Then I will now sell it later. So it really makes sense for me to do what? To lease it. So now I said I'm going to lease an asset for 10 years. So after 10 years, I'm going to return back to the south. Now, do you now know that IFRS 16, which is lease, IFRS 16 says what? That since you are leasing that asset, do you agree with me that IAS 16 says that I should recognize it as an asset, as a right of return, ROUA asset? It is called ROUA, right of use asset, right of use asset, ROUA. So that means after 10 years, I'm going to return that asset. So now there are some things that I need to like restore back to the normal state after the contract. So a decommissioning cost is a cost. It can also be called dismantling or decommissioning cost. That is a cost that you are going to spend at the end of the 10 years that will restore that place to how it is. Because after 10 years, there would have been your you have made some modification on that asset or on that property. So you need to restore it. A good example is usually land. When you buy a land, then you construct it, but at the end of the lease period, the lease tenure, you are going to restore it by diminishing all the building that you actually mounted on that land. So it is called decommissioning cost. So what IAS 37 is now saying is that once you have a decommissioning cost to incur in the future, you must do what? You must make provision for it. That is where I'm going. Where you have a decommissioning cost that you will incur in the future, assuming let's say it's 50 million you incur in the next 10 years. So IAS 37 says you should discount it to present value. When we discount that decommissioning cost to present value, that 50 million you discount it to present, then you recognize it as part of assets in line with IAS 36. So that is number one. Okay. Yes. Okay. Someone saying, can you hear me? Yes, people can hear me now. It's your network. It's your network, Mutias. So number two is environmental cleanup cost. That is the second example of provision. Environmental cleanup cost. There are some contracts. In fact, there are some companies in the South. This environmental cleanup cost actually happen in the South, where oil companies, they are going to do what? As a result of their operation that they deal with oil drilling and the likes. So what are they going to do? As a result of their work, they are going to um they are going to contaminate the rivers and the seas in the South. Then whereby what will happen? This might affect the members of the community. You know, majority of them are fishermen the majority of them are fishermen. So as a result of this oil spillage, it's going to do what? It's going to scatter and disrupt their business activity. So environmental cleanup cost is a cost that will be incurred by any organization, and um it is usually courts that mandate it for organization, especially those oil companies, that at the end of your operation you have to pay environmental cleanup costs. You have to make sure the rivers and all the society in which you are carrying out your operation, you have to make sure it is fine. So the second one is environmental cleanup cost. Now, the third one is warranty costs. Warranty cost. A third example is warranty cost. Is a situation whereby when you are selling warranty cost is that when you are selling goods to your customer. Now, there are some of the goods that might get spoiled as a result of one thing or the other. So you have to do what? You have to make up for that loss. If that loss is your fault, you have to make up. You have to make it up from your clients. You have to pay up. So that cost you will incur because you have given your customer warranty. All of us, we are all aware of some electronics. It usually happens in electronics that when you buy something, they will give you a warranty of 1 year or 2 years. So within that 2 years, since you have given your customer 2 years, if anything happens to that television or fridge, any repair you are going to spend, which will make up your warranty cost. So what I hear start saying is that you should do what? You should make provision for warranty costs. And that is where provision comes in. That thing has not happened. That warranty, that cost, you are not incurring it now. You are incurring it in the future. So, but for now, you must make provision for it so that in the future, you just settle that obligation. Then number four is restructuring costs. restructuring cost. Restructuring cost is a cost that will be incurred in the future as a sort of restructuring an organization. Example is merger and acquisition, all these business combination. So when there is merger and acquisition or these programs that will change the activities of the business, in the future you have to make provision for it, because there are some costs you will incur whenever you are restructuring. There are some staff you are going to lay off and you are going to pay compensation for. So restructuring cost is an example of provision. Then the fifth one is onerous contracts. An onerous contract is a loss-making contract. It's a contract where the benefits, the money you will receive from that contract, is lower than the costs. The cost you are going to incur in a contract is 100 million. Then the revenue is 90 million. Can you see that it is a loss? So an onerous contract is a loss-making contract. And if you remember very well, when you enter into a contract, IFRS 15 defines contract as a what? A contract is an agreement between two parties that creates rights, enforceable rights and obligation. That means when you enter into a contract and you see that contract, you are not going back. When that contract is sealed, you are not going back. So when you enter a contract with a person and the total cost of that contract is 100 million, then the revenue you are expecting, maybe you have negotiated the contract revenue 100 million. However, when you are now incurring costs, as a result of inflation or something else, the cost now exceed 100 million. Please, you don't have any say. You go ahead with the contract, because it is a contract, it has been signed and sealed. So as a result of that loss, IAS 37 says you should make provision for that loss, because you have entered into a contract, you cannot go back. So that is onerous contract, a loss-making contract. Now, the sixth one is litigation or legal claim. So litigation and other claim, it is very, very good. If you look at it, as there is a point there where certain criteria are met. That means where some criteria are met, that's when you can recognize litigation. You can recognize provision for litigation. So once those criteria are not met, you cannot recognize it. So those are the examples of provision. So before we are now moving to the next. Let's move to the next. Please, if you have any question on this, please, we can note it down in our notes. Please, let's note it down. So when it's time for question, you can now go back. You can go back. So now let's go. Recognition criteria. So now, recognition criteria for provision. It is very, very key. It is very, very key. Everybody, are we together? Okay. Yes, let's go on. Please, Mohammed Aisha. Okay, Mohammed Amino, don't worry. I'll take your question later. Please, we need to be fast for us to make sure we cover a very significant part this time. In fact, we need to finish up this standard tonight, and it's a long standard. Now, recognition criteria. So, as a result of the fact that provision, as I've said earlier, I said provision is a standard that was introduced to improve financial report. Okay, I mean not okay, no problem. It was a mistake, no problem. So let me recap again. Provision, as I've said earlier, I said provision is like a device. It's like a device, a very key device in which IASB introduced to make sure financial statement is present fairly, to make sure financial statement shows true and fair view. So the recognition criteria of provision is very, very key. And now that is the reason why um provision, the three recognition criteria of provision must be met before you can recognize it. It must be met. Sorry, let me take. So sorry about that. Let's continue. So now there are three recognition criteria that must be met before we recognize a provision in the financial statement. Number one, an entity must have a present obligation. As I said earlier, there must be a present obligation. That means currently we must be owing that money, whether it is legal or constructive. Please, we are coming then. I will explain that those ones very clear as a result of past event. So provision, that means a debt we have been owing from the past, but currently we have not paid it, a present obligation. Number two, it must be probable that the entity will transfer economic resource to another party. That's probable, we are coming to fix it, don't worry. It must be probable that there must be 50% chance that that entity will transfer that economic resource. And please remember, economic resource, don't let it to bobo you. It's like cash, assets, or other thing that can be transferred to another person. Then the amount must be reliably estimated. The amount in which that provision, that obligation must be reliably estimated. So please kindly note that all three criteria must be met. All the three criteria must be met before you recognize a provision. So please let's take note of that. All the three recognition criteria must be met. Now, let me now go to legal and constructive obligation. So now an obligation in line with IAS 37 and the conceptual framework, there are two types of obligation. There is legal obligation and constructive obligation. Constructive obligation and legal obligation. So now number one is constructive obligation. Constructive obligation is as a result of not in a contract. Let me put it in that short way. Not in that is an obligation that does not arise as a result of legal circumstances. Now, constructive obligation, number one is that it arises as a result of an entity's published policies, which create a valid expectation among other parties. Now, let me quickly break that one down. Now, there are some entities, examples of them are like Unilag. Examples are banks that are very close to Unilag. There are some banks that usually publish some policies that maybe in an accounting department now, any best graduating student that graduated with first class in Department of Accounting in Unilag, that bank is going to sponsor his or her master's degree, or they are going to give that person a job, an automatic job. So since the bank has already like published that every year, every academic year, any best graduating student in the Department of Accounting, there is going to be this is an example, this is just an example. There's going to be a scholarship, or we are going to sponsor his or her master's degree. So every year, if anybody graduates as a best graduating student in that department, automatically the bank has been like, it has an obligation to fulfill that promise. It is a published policy. It is a published policy. And since you have said it's every year, so next year now, you continue to like fulfill that obligation. So that is the first one. And that also correlates with the second point, which is an entity establish pattern of past practice, something you have been doing in the past, something you have been, as an organization, you have established that there's something you are going to be doing for a community. Or maybe you are going to building school, you are going to be building school for a community every year. Maybe that community is very big. So since you have like established that pattern on every year basis, although you um uh, you and the community, you don't have a contract. If you agree with me that in this constructive obligation, and that's why I said it, that constructive obligation, the simple way, is an obligation an organization have as a result of not having a legal obligation. You don't have a business with anybody. You and anybody will not come together to say you are going to be. But as a result of that, you have already decided in the past. You have already decided in the past, and you have not cancelled it. You have not cancelled it. So you have created an obligation that you continue to fulfill. So that is it. Then the second point is legal obligation. Legal obligation. Legal obligation arises as a result of law or contractual obligation. That legal is very, very simple. It is an obligation you do what? You are going to incur as a result of contracts. An example is decommissioning cost. You have a contract with a person that you are going to restore his assets back to the normal state after the contract. That is the commissioning cost. Another one is warranty cost. You said, whenever you buy this TV, you buy this flat screen TV, I'll give you a 1-year warranty. So after 2 months, the person now discover that the TV is having issue. He will bring it back now. As a result of the contract, both of you have sealed it, that you gave me 1-year warranty. So the cost you are going to incur on repairing that TV is a warranty cost, is an example of contractual obligation. Then onerous contract. I just explained onerous contract. Onerous contract now is a loss-making contract. A contract that arises as a result of you are making loss. The benefit is higher than the obligation. Then B is legislation. That means an example of environmental cleanup cost that I made mention of happening in the, let's say, Niger Delta region, where oil companies like destroys the rivers and the likes. So that is legislation. Then the third one is operation of the law. Example is judicial precedent. So a law that has been decided before, that is judicial precedent. A law that has been decided by a court before, that this was what happened between these two. So the law now is now that transaction or that circumstance or event now happened now. So you now went to court. So that operation of the law is going to be the obligation. You have to pay that obligation. So those are the two obligations, the two ways you can, like, I can't see your screen. My screen is here. Even I can even see my screen by myself here. So it's your network. Oh, people, are you still seeing my screen? Okay. Thank you. So now that is provision, constructive and legal obligation. So I think we can now move to recognition of provision now. So provision, generally recognition of liability. Now, if you remember very well, I know everybody, we are now in final level now. We are now in final level. We have done our year 16 in skill level and the likes. Now, we will have been seeing something that recognition criteria of our year 16. It must be probable that future economic benefit will arise as a result of past events. It is probable. You have been listening to probable. So IS 16 talks about what? IS 16 now defines what is probable. It was sorry IS 37. It discussed about probable, possible, remote, and virtually certain. So when we say something is probable, IS 37 says that the probability is that there must be 50% chance. There must be 50% chance that that thing will happen. So when a liability has 50% chance that you will pay it, IS 37 say you should recognize. IS 37 say you should recognize provision. When it is probable that there is 50% chance, so you must recognize provision. Now, when it is less than 50%, when it is less than 50%, IS 37 say it is a contingent liability. And contingent liability, we are coming there, it must not be recognized in the financial statement. Please, let's take note. IS 37 says contingent liability must not be recognized because it is just a possible obligation. It's an obligation you are going that is possible. Then remote. Remote is that when it is less than 5%. When it is less than 5%, IS 37 says you should ignore it. In fact, don't disclose it in the note to the financial statement. Then, when it is virtually certain, when something is virtually certain, it is 95%. So that is virtually certain. That is, we are going to recognize it. So that is recognition criteria. So IS 37 talks extensively on this. So now let's move to the next. Let's move to the next. Now, measurement of provision. How do we measure provision? So in the financial statement, how can we measure provision? How can we measure provision? So IS 37 says, provision is an uncertain liability. A liability you don't know sometimes. You don't know how much you will pay. Example is court case. A customer took you to court that as a result of your product, there are some damages. So it now took you to court. Do you agree with me that court is going to be postponing it? It's going to be postponing that judgment, and you don't know how much you will pay. So it is very, very difficult sometimes to estimate an amount of provision. And that is why IS 37 says that it should be measured based on management-based judgment. Based on management judgment, taking into consideration of historical information, what has happened in the past, present information, and forward-looking information. So generally, IS 37 says there are two methods of recognizing provision. So now, number one is that when provision has a large population, IS 37 says we should use expected value method. We should use expected value method. That is, an example is warranty. A warranty. When we have a warranty, IS 37 says we should do what? We should use expected method. But whenever we have a single or one-off event, example is restructuring cost, litigation cost, environmental cleanup cost. IS 37 says we should measure at most likely estimate to settle. Most likely estimate. You should just measure it based on estimate, but the estimate is going to be the most likely. IS 37 says we should do what? We should use historical information, present information, and forward looking. So we should now look at the most likely estimate to settle it. So that is the requirement of IS 37 based on measurement. So now, now we are now going to be picking the provision one after the other now. We are going to be picking the provision one after the other. So the first one is the decommissioning cost. So we are going to discuss extensively on decommissioning cost and require standard now. So that's number one, decommissioning cost. Now, according to IAS 37, provision contingent asset, where an organization or an entity is legally or constructively required to dismantle or restore the site on which an asset is located in the future, the entity must include the present value of the cost as the cost of the asset. For this purpose, the provision should consider time value of money. Do you remember that this decommissioning cost, I said it earlier that it is a cost you will incur in the future. So you must do what? You must consider time value of money, which is discounting. So whenever we have provision in the question, we must discount to present value. So simply put, the present value of future dismantling cost should be included as part of initial cost of the asset. Example, let me use a short example. In the future, we are going to incur a cost of 50 million for the commissioning or dismantling cost. In the future, let's say in the 10 years to come. And I expect some say we should make provision for it now. Something that will happen in the future, make provision for it now. So that is time value of money. The amount we have today is different from the amount we have in the future. So what are we going to do? We are going to discount it. If you remember in your group account and the likes, where they will give you future value, contingent consideration and deferred consideration in your group account. This is just the example. You just use 1 plus r raised to power minus n. Then you discount that 50 million. You discount it to present value. So I start saying you should add that discounted amount. You should add it as part of initial cost of that asset in the financial statement. So, and immediately where there is a debit entry, there must be a corresponding credit entry. So the corresponding credit entry must be a liability in your financial statement. And in this case, the liability is a non-current liability because it is more than 1 year. IAS 31 says any liability you incur that you are going to repay for more than 1 year, please recognize it as a non-current liability. So you are just going to put it in your non-current liability. Also, you are going to be calculating your unwinding costs, accrued interest. So you'll be adding your unwinding cost on a yearly basis to your provision, your statement of financial position. So while the accumulated unwinding cost will be recognized as liability in the SOFP. So that's the requirement of IAS 37. We are going to solve question on it. It's very, very straightforward. So now we are moving to environmental cleanup cost. So what is environmental cleanup cost? Just like I said before, I said it is a cost that you incur in the future as a result of law, or environmental policy to clean up any contamination. Also, the principle of time value of money applies because you are going to incur it in the future, probably maybe next year. So principle of time value of money also apply. But the major difference between environmental cleanup costs and decommissioning cost is that you are not going to capitalize decommissioning costs. That's why I quickly showed the accounting entries here. The accounting entries of decommissioning cost is you are just going to debit provision, P or L account, then credit your liability. So that is decommissioning cost. It's somehow related to environmental cleanup cost is somehow related to decommissioning cost. So another thing that the standard talks about is future operating losses. Future operating losses. Okay, we still have few more. We have future operating losses. So what is future operating losses? As a result of an organization making losses every year, we are making loss, we are making loss. Now, we now thought of it that this one that we are making loss, let's make provision for loss now. We are going to make loss. We have kuku know that we will make loss. So let's make provision for it. So IAS 37 says, no, please don't make provision. Please do not make provision for future loss. It is highly prohibited by IAS 37. So this is very clear. Future operating loss, because there is no present obligation. That loss, that obligation will be in the future. So that is future operating loss. So the next one is restructuring costs. Sorry, I need to. Sorry. Okay. Do we have any question in the chat box? No. Okay, network challenge. Okay, someone say I'm too fast. Oh, wow. What am I going to do? We have to finish this. If my plan is that unwinding cost. Okay, unwinding cost. So let me quickly explain this unwinding cost. Now, let me quickly explain before we move on. Someone say I'm too fast. I don't have a choice, so we have to finish it up. So now, unwinding cost. Whenever there is time value of money, unwinding costs must occur. Please, let's take note of it. Now, let me break it to a simple layman term language. Now, there is a cost I will incur in the future. Now, there is difference between time value of money and something that is not time value of money. It is very, very simple. Let me use this simple example. Next month, I said next month. Yes, next month, I am owing an individual money. And we have an agreement that I'm going to settle that person next month. Example is, let's say I'm owing an individual 10 million and I say I'll pay you 10 million next month. Even though it's risky, but we can still say it is fine. Since it is next month, I'll just make provision for 10 million naira. What am I going to do? I'll debit my provision expense in my POL. Then I'll make provision in my SOFP. I'll credit my provision. That's it. Then next month, immediately I settle that 10 million naira, I'll do what? I'll debit my provision. So it will cancel that liability. The provision in the SOFP is not POL. I'll debit my provision in the SOFP, then I'll credit my bank since I have paid. So now that is example number one. Now example number two is now that I am owing somebody 10 million naira today. Now, according to the contract, that person now says, I don't need this money now. Please pay me next year. Please pay me next year. This 10 million naira, please pay me next year. Now, what time value of money is now saying is that 10 million naira you have today, it is not the same 10 million naira you have next year. That means inflation would have occurred. We are all using phone. We are using laptop now. When you buy phone this year, you buy phone of 500,000 this year. When it becomes next year, that phone would have increased to maybe 700k or 800k. Because of what? Because of time value of money. Money you have today is different from money you have tomorrow because of time value of money. So whenever there is time value of money, it is better to discount. It is better to do like a shortcut. And the shortcut is that In layman term, you should go and do what? You should go and fix that money. That 10 million naira, for it to be your 10 million naira, what are you going to do? You are just going to go to the bank. Tell a bank that you want to borrow them this money. You don't need it now. Now, they should be giving you an interest. They should be giving you an interest. Even though you don't need to, what you need next year is that 10 million naira. What you need is that 10 million naira. In like, you don't care about the inflation or something, no. That 10 million naira is what you need, and that's what you want. So bank is going to arrange between the bank, they are going to okay for you to make sure this 10 million naira, you are going to agree on an interest rate. So in this instance of unwinding cost now, let's now take it to like 5 years. You said 10 million naira, I'm going to pay you 10 million naira in the next 5 years. In the next 5 years, 10 million naira cannot be 10 million naira. It will have changed. Your liability will have increased to maybe 50 million. So to do what? You are just going to have an arrangement with the bank or any other financial institution that they are, both of you now agree an interest rate. So that interest rate is your unwinding cost. So on a yearly basis, you will be applying that interest rate under your 10 million naira. So you need to discount. You discount that money, that 10 million naira. They will discount it to your present value. So when you use 10, maybe you can use 10%. When you discount it, it will have been like 8 or 7 million naira. So on a yearly basis, the interest will now be adding to it. The interest will be adding to it. In the next 5 years, that money will be exactly 10 million naira. That's how time value of money works. Whenever you have an obligation or you are expecting the money that you will receive in the future, you must discount it. And a discount, a relevant appropriate rate is going to occur. So, and that amount is going to be applying every year. So let's say, for instance, now 10%. What is 10% of 10 million naira? That's 1 million naira, right? 10% of 10 million naira, I think that's 1 million naira. So when your unpaid interest, that's your unwinding cost. You'll be applying it yearly on yearly basis till that 5 years. Then it's now going to be your 15 million or 10 million as the case may be. So when we use an example, you understand it better. But unwinding cost, another name for unwinding cost is accrued interest. On accrued interest. But in professional level now, they call it unwinding cost. So you have to be adding your unwinding cost to your provision every year. Every year, you'll be adding it and you'll be debiting your expenses. So in the next 5 to 10 years, it will result to that same amount you need in the future. So that's it. So let's continue now. Past 10 already. Wow. Now, restructuring costs. Restructuring costs. Now, restructuring costs is also a key, is a key topic in IAS 37. IAS 37, they made sure that restructuring is very, very important. Now, IAS 37 define restructuring as a formal and detailed program controlled by an entity. A formal or detailed program controlled by an entity which is capable of affecting any of the following. A formal and detailed program controlled by an entity which is capable of affecting the following. So one of them is the scope of the entity. Number 2 is the ways and manners management of an entity will be conducted. That means a formal and detailed program that will affect the scope of an entity. You know, I make the example. An example is reorganization. When an entity is reorganizing its setting, where an entity is reorganizing um the way the business is, it is going to affect so many things. There are some people that will go. The company is going to like sack some people. So that is restructuring for you. Whenever there is a restructure, an example is merger and acquisition. We all remember when Access Bank and Diamond Bank, when they did merger and acquisition, when both of them now merge and they became one. So now the question is that all the staff of Diamond Bank, what will happen to them? That's the question. All the staff of Diamond Bank, where are they now? So now it is going to affect a lot of things. That is why I started saying the divine is at a formal or detailed program that is capable of affecting the scope or the manners and management. So another example is this decision to discontinue a branch or a component. So when you want to discontinue a branch, you are going to like embark on so many activities. Some people are going to go, you are going to sell some assets, you are going to do this. So that is restructuring. Now, restructuring is an example of provision. Restructuring cost is a big example, like a huge example of provision that is very, very clear. So number one of the recognition criteria for restructuring cost is what? Is that there must be a detailed and formal program. That means the management of the entity would have they will have make sure everything is formal. They would have made announcements. This formal, when I say something is formal, they will have made an announcement that this 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 restructuring is going to come up next month. It's going to this restructuring is going to happen next quarter. They will have announced it. That is the reason why they called it the first recognition criteria is that there must be that the organization must not be thinking that it's like we will restructure, it's like we will not restructure, it's like we will restructure. They are now doubting it. And start 7 says no, please don't recognize provision when you are not sure. But when you are sure that there is a provision, there is a restructuring next month or next quarter, then recognize provision. Then number 2 is that the management of the entity must have communicated to the affected parties. You must as the management, they must have communicated. So IS 7 gives us the various examples of restructuring costs. Number 1 is cost of terminating existing contract. There are some contracts we would have embarked on as a result of the formal program. So now, since you are now having a new program now, so you have to terminate that existing contract. Number 2 is professional fees. The professional fees you are going to incur, redundancy costs. That's like a cost of a cost you are going to incur to what am I going to call it? To settle the people you are sacking. That's redundancy cost. A cost that you incur to make sure they are well compensation. Yes, a good example is a compensation cost. The cost of compensating your staff that lost their job as a result of that restructuring. You have to incur a redundancy cost. So IS 7 say is part of the restructuring cost. Then any other directly attributable cost. Now immediately IS 7 gives us what? There are some costs that must not form your restructuring cost. The number 1 is cost of training new employees. Now, as a result of new employee, as a result of that restructuring now, you are now training new employees. You now want to incur costs. You now want to put it as provision. No, because that program is still next year. It has not even happened. Although you have made the provision, you have made the detailed program now, but it has not occurred. So don't make provision for cost of training new staff, cost of recruiting new staff, no, cost of relocating new staff, marketing costs. So all these costs, can just paint a scenario and set provision and set provision. So they will now ask you to recognize which one should be a restructuring cost and which one should that is not restructuring cost. Now, then we have reimbursement. Let's move on. Reimbursement. 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 So reimbursement costs. So reimbursement is like an asset. Please let's take note. Reimbursement is like an asset. Is a situation whereby we are incurring a cost to make sure we are going to like cover a risk. You know, in life, there are some risk. In fact, life is all about risk. Life is all about risk. So there are some costs we are incurring on a monthly basis to make sure we are covering some risk. Now, the best thing, example of it is insurance. Do you remember that when you have a risk, when you have a risk and you want to take that risk, it is better to go for an insurance. So when you have an insurance company that as a result of any uncertainties, they are going to reimburse you. That cost is a reimbursement cost. So IAS 37 says that you should make sure you cannot recognize that reimbursement unless if it is virtually certain. Unless if it is virtually certain. A good example is maybe we have a motor vehicle. Do you know that you'll be paying insurance premium every year, every month? You'll be paying an insurance like a monthly payment. So if anything happens to your car or your vehicle, they are going to reimburse you. So IAS 37 says you should only recognize provision for reimbursement, or you should only recognize reimbursement as an asset when it is virtually certain, that when it is 75% sure that you will receive that asset, that you receive that reimbursement. IAS 37 say you can now recognize it. So, and the reimbursement should be recognized as a separate asset in the financial statement. Then we have the onerous contract. We have the onerous contract. So, just like I said earlier, I said onerous contract is a loss-making contract. Onerous contract is a loss-making contract. It is a contract that arises as a result of loss. You enter into a contract. You now do that. You now realized. Sorry, you realize that this contract is loss, so you are not making profit. So since you have entered the contract, you don't have any choice. You have to finish the contract. You have to finish the contract. So, okay, please let's finish up first before we take question. Before we take question. So my plan is that let's finish up this note tonight. So by next week in my next class, I have recognized two past questions. So we are going to solve past questions. Those two past questions in my next class. However, let's deal with this note tonight. So by my next class, I'll just resend that YouTube link in case you want to watch it again. Then we solve past question on provision. We will solve one past question and we will solve one ACCA question. So that's my plan for next week. I see that we cannot solve any past question tonight because I know people will have been sleep. Some people will have been sleeping by now. I'm very sure because when you are doing reading, that is not calculation. People will have been sleeping. So let's discuss about provision tonight for 1 hour 30 minutes. So when it is 10:30, we end the class. So by next week, we now solve two questions. We solve one ACCA question, then we solve one I can pass question. So that's what we are going to do. So we are done with onerous contracts. Onerous contract. So there is a point I quickly need to say about onerous contracts. My network is my network. Is something wrong with my network? Okay, maybe the viewer is talking to another person. So now on onerous contract, as I said earlier, is there's no problem about the material. I'll forward the material. Yes, I'll forward it when we are done with the class. Yes. So now an onerous contract is a contract that is unavoidable. Unavoidable costs. That means the relevant costs exceed the economic benefit that is expected to be received in a contract. That is expected to be received in a contract. That is the definition of onerous contract. And I made mention of it. A good example is a situation whereby you you have a contract with an individual that you are going to carry out a project. That contract has been signed and sealed that you are going to supply you are going to receive 100 million naira to do what? To construct a building. And now, if you know that there are some contracts, and that is why contract account is somehow different. If you remember contract account, they are going to give you your retention fee. Then later they will give you maybe 60 to 70%. Then you now collect your balance. So contract is very, very dangerous in the sense that when inflation occurs, when inflation arises, if you are not very careful, you are going to make a loss. So, and this actually happens in outside country. I've seen this in UK, whereby it will be specifically cited in that document that you cannot immediately both of you enter inside that contract. You cannot leave that contract. You know, there are some contracts that when you look at it, when you are embarking on it, you now see that I'm going to make loss on this contract. You just withdraw. I cannot do this contract. You just withdraw. So there are some very sensible people that they will have from the beginning of the contract, they will tell you that let's sign a document. You are not withdrawing from this contract. You must finish it. How much do you want to collect? 100 million. You are going to finish with 100 million, then you sign it. So if you now spend more than 100 million, example, you spend 120 million, do you know that that is a loss? You receive 100 million, the total money you now paid, the total costs, unavoidable costs, relevant costs is now 120 million. So there is a loss of what? 20 million. So that 20 million, IS 37 says you should recognize it as a provision. In fact, it is very sure. Please recognize it because all the three recognition criteria can be met. Number one is that there is present obligation. You are owing debt. There is an obligation as a result of the contract. Number two, it is probable that you transfer economic resource to another party. 20 million, it is probable that you will spend that 20 million for you to fulfill that contract. Then the third one is that the amount must be reliably estimated. We have even calculated that I'm making a loss of 20 million. So when the three recognition criteria has been met, you do what? You just recognize. So you do what? You recognize the provision. So that 20 million naira is a lot. So there is now clause. There is a clause in our year 37. I think I'll add it to the note before I send it. That the provision is what? It is higher of two things. Higher of the loss, and the penalty you are going to pay. The penalty you are going to pay. Let me quickly explain it before we move to contingent liability. A situation whereby, now let's use our simple illustration that I used. I said we receive 100 million to carry out a contract. Then we now discover that we are going to pay 120 million to execute the contract. How much is the loss? 20 million, right? Now, there's now a clause in the contract. The clause is that if you decide to leave that contract, you will pay a compensation fee of 10 million naira. You will pay a compensation fee of 10 million. If you decide to leave the contract, you will pay a compensation of 10 million naira. So now, let me now ask a question now. The question is that, will you rather pay the compensation of 10 million naira, or you will execute the contract and make a loss of 20 million? Which one will you do? Let me just ask this question. Okay, Joy. Okay, can Joy quickly tell us before we can move on? Okay. Okay, Joy, can go on. Okay, Mr. Solomon has already said it. It is better, yes. It is better to pay a compensation of 10 million, right? So it makes sense to pay a compensation of 10 million and leave the contract than to do what? Than to make a loss of 20 million. So what I started is now saying, whenever you want to make provision, you should make provision for 10 million naira. The lower of the two. It's not that you are not going to go and be like Baba Olowo. You are the one that have arrived. You now go and make provision for 20 million, where there is an option for you to pay a compensation of 10 million. So the provision you are going to recognize is 10 million naira. So I'll add it to this note before I send it tonight. So let's move to the next one. Is contingent liability and contingent asset. Now, contingent liability is a possible obligation. Just like I said, it is a possible obligation. An obligation that is possible. That it is not sure. It is not sure. It is not sure that you will do what? That you, example is court case. A court case. I made mention of it earlier. It is a court case. And what are they saying? They said a customer took you to court that you must pay for damages as a result of your product. Now you now went to the court, then your doctor now told you that. I said doctor, sorry. Your lawyer, your professional lawyer now told you that the probability that we will lose this case is 30%. That means there is 70% chance that we will win the case. Maybe the lawyer has gathered enough evidence that we will win this case. You now ask the lawyer, what is the percentage? We are 70% sure we will win this case. So there is a 30% chance that you will lose the case. So that provision here, and if you remember, when you have a 50% probability or less, it is a possible obligation. So contingent liability in that instance, in this example I just made, contingent liability, because there is 30% chance that you will lose that case. But if it is more than 50%, let's say 60% or 55%, I'm sorry, you recognize provision. When your lawyer told you that there is 50%, there is 60% chance that we are going to lose this case. you will recognize provision. And that's why IAS 37 defines contingent liability as a possible obligation that arises from past events whose existence will be confirmed by occurrence or non-occurrence of future uncertain events which are not within the control of an entity. That's the definition according to the standard. So IAS 37 requires contingent liability should never be recognized in the financial statement. You should never recognize contingent liability in your financial statement. Never and never. However, a disclosure is required in the financial statement. You should disclose it to the users of financial statement, except when it is remote. The standard says when it is remote, please ignore it. If you go back to the notes, you are going to ignore it. But when it is material, you disclose it. Then the same thing as contingent assets. It defines contingent asset as a possible asset. A possible asset. A asset that is not sure. An asset that is not sure. It is not sure for you. You don't know, maybe you collect it, which arises as a result of past events, whose existence will be confirmed by occurrence or non-occurrence of future uncertain events, which are not within the control of the entity. So, IAS 37 requires contingent assets should never be recognized in the financial statement. However, a disclosure is required in the note if they are material. So, a contingent asset and contingent liability are somehow the same. So, they are possible obligation and possible assets, which will be disclosed if they are material. If they are not material, please do what? Please just ignore it. So that's the end of the note. IAS 37 is actually long. I just try to like shorten the note so that we are not going to be seeing like 7 pages or 8 pages. So I just shorten the note. So I'm going to add that onerous contract to it. And what again? Maybe I'll add litigation to it. The next week we'll solve question. So this is 10:30 already. So let me just take one to two questions, then we call it a day. If you have any question, I think someone had a question the other time. So, are we fine? If we are fine, we can call it okay. Mr. Kayode Adebayo. Okay. Let me. Oh yeah, you are muted, sir. Please, can you go ahead? You are muted now. Okay, go ahead, sir. Still muted. You can talk now.
Okay. Good evening, sir. Thank you very much. Okay. My question is regarding the redundancy. I was asking that if like that severance, is it part of a redundancy cost?
Like severance? Like I don't understand. What do you mean by that, sir?
Okay, I think I understand severance as where a company is leaving those staffs that maybe probably because of margin or acquisition.
Merger and acquisition. So they are now leaving them behind, Abby?
Yes, that maybe they are no longer needed again. So the amount paying them, sometimes company pays severance, I don't know. So that is it part of the redundancy cost also?
Exactly. Yes, it can be regarded as redundancy cost. The cost of a cost of compensation. Exactly. Compensation. For you to compensate them that we are sorry about this job loss. So it's yes, it's a redundancy cost. So it will form part of cost, yes.
Okay, thank you. And secondly, sir, that of onerous contracts.
Yes.
So you mentioned that is either we recognize by paying by making a provision of lower of cost to fulfill or
Yes.
to compensate.
Yes.
Then
Yes.
I understand the fact that we are supposed to take the lower, but in a situation whereby the company that is supposed to pay the lower is looking at how to retain the customer, and I don't know, will
And
this still
that's
go ahead?
what exactly that's what the standard is now saying.
That if it's as a result of like retaining that customer, like the relationship is very key, you want to maintain that customer, you can now go ahead to carry out that contract. Then IS 37 say you can now recognize that 37, you can now recognize that 20 million.
20 million, okay.
Yes, you can now record because as a result of that customer is your close customer and you don't want to lose him. And that is why the standard is a principle based. It talks about what about when there is a situation or like this. So you are going to recognize that 20 million.
Yes.
Okay. Thank you so much, sir. That's
All right.
very
Yes. Yes, sir.
So let me take Faith. Okay. Miss Faith, can you go ahead with your question? Okay.
Okay, good evening, sir. Thank you so much.
You're
Please,
welcome.
can you shed more light on contingent asset and liability? There's a point that you mentioned if the chances is 30% or less, it becomes a
Okay.
contingent liability. So I don't really get it.
Okay. Let me quickly move my note to the top. Please look at my screen. Please look at my screen here. IS 37 gives us guideline. Look at it. Recognition of liability. IS 37 says that when the probability that you will pay liability is more than 50%, IS 37 says you should recognize it, that it is a provision. However, when it is less than 50%, IS 37 say it is a contingent liability. That means it is a possible. So IS 37 will give you guideline that just 50%, just make sure you are looking at 50%. So the example I was now giving the other time is that a customer took you to court as a result of the product you sell to him or her. Now, the case is still in the courts. And in your financial statement, maybe the case will be decided next year, next accounting period. But as at today, you must make provision. So now, for you to now make provision, IAS 37 says you should go and engage a professional, a professional. In this case, a professional lawyer. Now, let the professional advise you. What are the chances of winning or losing this case? When the chance that you will lose this case, when the chance is that I'm going to lose this case, so is more than 50%. Example, there is 70% chance that we will lose this case because maybe they have collected the sample of that product, they have tested it, they have said that this product is not good for consumption. So the lawyer have acquired necessary evidence that we will lose this case. So since we are losing this case, and you already know your lawyer, since your lawyer have like advised you, sorry. Hope you get it right. So that is it. Since you have the necessary information that you are going to lose this case, so you are not going to make provision. So that is a contingent liability. So that is it. Hope you understand that question like that. So
Yes, sir, thank you.
you are welcome. So that's where we are going to end the class tonight. So thank you, everybody. By next week, we are going to continue our class. We are going to solve past question on the class. So thank you, everyone. Good night, everybody. Good night.
Yes, sir. We really
Good
appreciate
night, everybody. Good night.
Please, sir, is the note on the platform?
Thank you, sir.
I will send it to the platform. Don't worry. Good night. I will
Okay.
send it immediately. Yes. Good night.
Right. Thank you. Good night.
You are welcome.
Good night.
Good night, everybody. Good night.
Good night, everyone.